Despite today's volatile session on Wall Street, our next guest says the stock rally is not only sustainable, but the economy is headed for a self-sustaining expansion. Joining us right now from Cincinnati is Nick Sargen. He's Chief Investment Officer at Fort Washington Investment Advisors, where he's responsible for overseeing more than $30 billion in assets. Now, prior to joining Fort Washington, he was a global strategist on Wall Street for 25 years, lots of experience. Nick, good to have you back here on Street Smart. So you think there is still more room to the upside here?
Well, Carol, I think the key thing is we got to this level. Can we hang on to it? And again, you can always have pullbacks, but I do think at least by the time the dust settles at the end of the year, this is a sustainable level. And what the key assumption is that this recovery is becoming self-sustaining. It's broadening, and I'd say March
but not necessarily
was as
to
close
the not necessarily to the labor market, though. I mean, it's better.
No,
but
absolutely. I'm talking in general the trends in the economy, and I'm assuming that the labor market will begin to turn. So I was really saying, I think though March was kind of the Goldilocks scenario, where you had the economy broadening, you had profits looking good, inflation low, Fed on hold. But as you say, we're not completely out of the woods. But I am hopeful that really, I think the key is we've seen a much quicker turnaround in corporate profits in this cycle than we did in the last bear market. And I'm hoping that that begins business capital spending and hiring before too long.
Are you seeing that? I mean, do you see that in the Intel report? Are you seeing that in the earnings reports we've had out so far? It's almost unfair to ask since they've been so good.
No, well, they're early indicators, but again, yes, I would say that the Intel report is kind of indicative. We think, for example, Matt, in tech space, we've gone such a long period of time where businesses have either let equipment or software, basically they're hanging on to existing equipment. And we think we're just in for a replacement cycle, if nothing more. And I think that Intel is an early indicator. Again, you saw in the J.P. Morgan earnings yesterday in terms of just credit problems that for the first time they're saying that's beginning to abate, and that's the first time Jamie Dimon then therefore has stepped up to the plate and said he's a little bit more confident himself.
Are you as optimistic? I mean, Carol, asked about this as well, but are you as optimistic that companies will be replenishing staff as you are that they're going to be replenishing equipment and computers?
I think I'm more confident on the equipment front. And I think that the jobs will be, the last, first of all, what did they do? They really took inventories down. Now they're beginning to replenish inventories. The last data we had for the fourth quarter was showing the beginnings of a cap spending increase that I think continued into last quarter. And again, as you indicate, that the job situation is the last to turn. The first real positive sign was March, and we have to play it out from there.
Later on, we're going to talk with Bob Shiller over at Yale. He tracks very closely the housing market. He called the housing downturn. He was right on the money. He's questioning, despite the better numbers in terms of housing prices, and they're not getting worse, he still questions. He says, don't bet the farm yet on the housing recovery. Housing, though, Nick, still problematic. And I mean, if you put that into the equation, I mean, how much of a drag could that potentially be on the economy and on the markets potentially?
Well, that's a great question, and I do respect Bob Shiller. He made the right call. I read his article, and the housing sector, Carol, is the area where I'm saying is also not really turning. So I'm accepting that is still somewhat of a drag at best. The one thing, though, I would emphasize is, though, what really got us into the funk was when housing spilled over into the financial system, the credit markets. That was what nobody saw coming. And that's why even if he's right on housing and there's a double dip there, I still do not see that we're going to go back into the funk that we were in the credit market. So that's, I think, the one difference that I would have from where we were 2 years ago.
I just, considering the fact that you're not so sure about housing, you're not overly optimistic on labor, and the markets have marched up so far, 80% from the lows, aren't you concerned that we could stall out here, at least as far as the stock market is concerned?
You know, Matt, that I always say that that's the price of admission when you have a market that's gone up almost straight and you're up 80%. So we're not adding to positions right now, and in fact, my analysts that we're a value shop, they're telling me it's getting harder to find easy pickings. So what we're doing is simply saying we'll hold on to what we have. If the market were to dip, then we might be buyers on dips. But I agree with you. I don't want to chase this market after the huge run it's had.
All right. Hey, Nick, thanks so much for joining us. Nick Sargen there. He is Chief Investment Officer for Washington Investment Advisor.